What if we didn't print any more money? What if the money expansion rate was 0? In that case, you could just store your money in a bank and it would be more valuable in the future, not less valuable. Why is cash trash? Because I had a value stock with a lot of cash and the money supply is expanding. Look at it from the point of view of an investor. They can invest in the S&P 500 index or the NASDAQ, and those were all up like 40%. Or they could hold cash and get 0%.
Also, only a tiny percentage of my viewers are actually subscribed. If you enjoy the video, consider subscribing. It's free and you can always change your mind. Enjoy the video.
It's a problem that anybody that works for a salary has, which is I generate a cash and the currency is being devalued every year. The real question is, what's the rate at which it's devalued? And let's do the thought experiment. What if we didn't print any more money? What if the inflation rate, the monetary inflation rate, not the CPI, but what if the money expansion rate was 0? In that case, the currency is also an asset and it's a store of value and a medium of exchange at the same time. That's a complete Austrian economics, like deflationary economy where we call it hard money or sound money. The closest thing to that would be the gold standard. If the government said you can exchange your money for gold at any time and we'll keep gold equal to the amount of money and we won't print any more money, well, that puts you on a hard money standard. In that case, you could just store your money in a bank and it would be more valuable in the future, not less valuable. When the government goes off the gold standard, and we went off the gold standard explicitly in 1971, now the currency is losing some percent of its purchasing power every year because it's being inflated away. And what's the number? Well, it was about 7% a year. And now it's like 20% a year and 15 to 20% a year, and you got to figure out, is it 15, 20, or 25? But if it's 15 to 20, the currency is weakening 1 to 2% a month. When it gets to be 40 to 50, it's collapsing. That's Argentina. Or worse. So you've either got a country where the currency is weakening or a country where the currency is collapsing. When that happens, now you have a decomposition. The money is broken into two components. You have a currency component, which you use as a legal medium of exchange, like the dollar or the euro or the yen or the renminbi. And then you have an asset component, which you use as a store of value over the long term. Money or US dollars have ceased to be a store of value for at least the past decade, since the great financial crisis. So what people did was they stampeded into ETFs and index funds, right? And to a certain extent bonds, right? How do you store your value over the long term? Well, if I take money and I buy a mixture of stocks and bonds, that will store my value, because if the economy is healthy, the stocks go up by 10% a year. The S&P does. And if the economy is not healthy, the Fed will lower the interest rates by 50 basis points and the bond will trade up. And so that works for how long? It works, watch the interest rates for the last decade. It works until you crank the interest rates down to 0. It used to be overnight money was 550 basis points, Tom, before the great financial crisis. And then they cranked it down from 550 to 500 to 450 to 400 to 350 to 300 to 250 to 200 to 150 to 100 to 50 to 0. And now we have, the bankers say, I'm not even thinking about raising interest rates. So that breaks bonds as a store of value, unless you go negative interest rates. And stocks work, except for the fact that, what stocks worked in the past decade? Apple, Amazon, Facebook, Google, a big tech company that grows 20% a year top line. When Apple stopped growing 20% a year top line, they fixed it by taking on massive amounts of debt, buying their stock back, and leveraging up their EPS. So companies that grow faster than the rate of monetary inflation, faster than the 7%, they could hold value. A company growing 20% like Google, Facebook, or Amazon, they all hold value. In fact, they accrete value. Why? Because 20 is more than 7, right? So it's plus 13% a year, right? what happens to all the other companies? Which companies in the S&P 500 amounted to all the indexes, or to all the gains? It was big tech, right? Big FANG stocks were the winners. Everybody else treads water, because if you're growing at 7% and the money supply is collapsing at 7%, you're net zero. And how else do you get around it? Well, you can go borrow a lot of money, leverage up, buy back half your stock, and get your cash flow per share up. But what happens when you're fully leveraged, which is like where they are right now? You can't do it anymore. So what's the problem right now? The problem today is the currency is being devalued at 20% a year, not 7% a year, right? I turned up the heat in the frying pan. And the second problem is some stocks could hope to grow 20% a year, like the minority, 5% of them could grow 20% a year for the past decade. What percentage of stocks can grow 30% a year? Because now you got to grow 30 or 35% a year because the hurdle rate just jumped. Now you're pushed out on the risk curve here. You got to take massive risk as a company to grow that fast. You got to do acquisitions. You got to burn the candle on both ends. You got to take on massive new leverage. This is squeezing. Value stocks don't work, right? I mean, it squeezes you out of the value stock trade, because if the company is reliable and it's growing its cash flows 5% a year and the money supply is expanding at 20% a year, cash is trash. Back to my story, right? Why is cash trash? Because I had a value stock with a lot of cash and the money supply is expanding. Look at it from the point of view of an investor. They can invest in the S&P 500 index or the NASDAQ, and those were all up like 40% year over year or something, or they could hold cash and get 0%. Nobody wants to hold cash. And so they might as well just take it and put it into something else. Now, long term, you can get a bump on equities when you have a boost, when interest rates get spiked down. You saw it. When we flood the market with liquidity, initially that makes stocks go up. But let's take the example of Zimbabwe and Argentina. If I keep doing it for 10 years, what happens to those stocks? They don't go up. Right? The problem over time is stocks are valued based upon the discounted value of the cash flows, or at least in part. And so if I give you a company generating $100 million in cash every year for the next decade, but I tell you there'll be 10 times as much money in the economy in a decade, that $100 million of cash will only be worth 1/10 as much in a decade. So the discount rate is jumping, which means the value of the cash flows into the future is collapsing. The road to serfdom is working exponentially harder for a currency growing exponentially weaker. And so how do you solve the problem? And the solution to the problem is you convert your assets from a weak currency that's inflating into a strong currency, or a strong asset, if you will, that is deflating. Right? The simplest example is, I'm a wealthy business person in Argentina, and the peso is trading 3 to the dollar, 3 pesos to the dollar, and the year is 2003. And now I can go forward and I tell you, well, in the year 2020, the peso is going to trade 150 to the dollar on the blue market or the black market. That's going to be the real rate. So what's your best strategy? Work hard, diversify into other Argentine companies making pesos? No. Your best strategy is convert all your existing pesos into dollars and get it out of the country. And your next best strategy is forward finance your cash flows and convert those into dollars, get them out of the country. And your next strategy is sell equity in your ranch or your business in pesos in 2003 at 3 to 1, 3 pesos to the dollar, and then buy dollars because the dollar is going to go up by a factor of 50. So what you're doing is you're financing in a weak currency, and then you're converting into a strong currency. And that's pretty obvious if you lived in Zimbabwe, or if you live, Lebanon went from 150 Lebanese lira to 700, it went from 1,500 to 7,500 overnight.
Whoa.
So it means you lost 80% of your money if you had it in a Lebanese bank. And so the answer, of course, is convert your lira while it's 1,500 to the dollar into dollars before the devaluation. Right? Now, what can you do if you're a modern business person, right? If I can't convert to dollars, the next best thing is buy something tangible that won't lose 80% of its value overnight. Buy a boat, buy land. Traditionally, people bought other tangible assets, gold, right? Something like that. But if you buy an asset which is valued based upon its expected future cash flows that are in that collapsing currency, that doesn't work for you. Like, you could own every good business in Venezuela. How's that going to help you when the Venezuelan currency collapses by a factor of 1 million? Jesus. It won't. Okay, so what's Bitcoin? Well, Bitcoin is the strongest asset the human race has ever invented. It's like gold with none of the defects of gold.